Welcome to Commercial Real Estate Unfiltered, the podcast that takes the mystery out of commercial real estate and makes it accessible for everyone. I'm Caleb David, a broker, investor, and community builder with over a decade of experience helping businesses and individuals bring their visions to life. Here we break down the market, share expert insights, and talk about the opportunities that commercial real estate creates for businesses and communities alike. No fluff, no gatekeeping, just real, unfiltered conversations that empower you to navigate the space with confidence. So whether you're an investor, a business owner, or simply curious about commercial real estate, welcome. Let's dive in. Well, everyone, welcome back to the show, CRE Unfiltered. Today, I'm joined by Kevin Jerry, who is a nationally recognized expert in real estate tax strategies, specializing in cost segregation, tax method changes, and maximizing tax efficiency for commercial real estate investors. As the owner of Kevin A. Jerry MST and Associates, Kevin has worked with some of the largest property owners in the country, guiding them through advanced tax strategies that go way beyond the scope of traditional CPAs. His deep expertise in IRS Code Section 263A, cost segregation, and depreciation enables property owners to expense renovations, structure holdings for maximum tax advantages, and reduce taxable income. Through his real estate trading platform, RETSI, Kevin educates commercial investors on the same tax strategies used by institutional players like BlackRock, empowering them to make smarter financial decisions that optimize their portfolios. Kevin, welcome to the show. We're so happy to have you here, especially on such a topic that is intimidating for a lot of people, including myself. So I'm really happy to have you here. So would love to have you maybe share a little bit about yourself, a little bit of background, and how you got into where you are right now.
Well, first of all, Caleb, thanks for having me. You know what you're doing is for your listeners is amazing, and your listeners should be extremely grateful for the effort and time and money you're putting into this to help them avoid overpaying taxes. So, how I got into this business, totally by mistake. You know, I was in a prior life. I was a printing press salesman. I mean,
Okay.
talk about 180 degrees.
Yeah.
And then during the Great Recession, printing slowly started to go away. So I had to take a look and kind of reinvent myself and say, okay, this is an opportunity to start over, maybe have a second career. And a buddy of mine called me and said, "Hey, have you ever heard of this tax strategy called cost segregation?" I was like, "No, I've never heard of it." He said, "Why don't we go into business together?" He was like, "No, we're not going. I'm not going into business with you." But I check out cost segregation, and it was amazing. It was this absolutely incredible risk-free opportunity to reduce for owners and investors of commercial residential rental properties to reduce their taxes, and yet nobody knew about it. This was back in 2010, even though the concept, it was 10 years old at the time. And so what I was hearing, Caleb, from owners and investors is, oh, well, you know, I've got a great CPA. If my CPA didn't tell me about it, this must not be legit. And it was like, well, maybe it's not. So I went and started knocking on CPA's doors and say, have you ever heard of this? And they're like, yeah, we've heard of it, but we're not touching it. So I decided, okay, I went back to school, got my master's degree in real estate taxation because I knew nothing about taxes. I was selling printing presses.
Right.
And then I realized that CPAs only know a small portion of the tax code, and even if they're real estate CPAs, they only know what they're taught, and what they're taught in in undergrad and grad school, and even in grad taxation where I was in, none of this was taught. So if it's not taught, it's not in the CPA exam, and your CPAs don't know about it, then how's it going to filter down to the individual investor? And that's when the bells went off and said, oh my gosh, this is a great opportunity, not only to build a business, but to really help people change their lives and change their families' lives by reducing taxes legally. So that's how I got into it.
No, that's awesome. And I kind of, as we talked about a little bit before we started recording, people don't know what they don't know. And we want this platform to be that thing that informs folks. So I'm really excited to get more input and learn more from you. So let's start with, what is cost segregation?
Mm-hmm. Yeah, and that's kind of a big part of our business. Cost segregation is nothing new. It's Caleb. It's been around for 100 years.
Wow.
Um, and and
Wow.
and and I say that to people and like 100 years. How's that even possible? So let's take a step back. Let's just touch on what depreciation is. When you have an asset that you use in your business, you have to depreciate that. It's the law. It's a great law because it reduces your income based on the wear and tear and reduction of the value of an asset as it gets, as it gets used.
Yeah.
So like your office furniture has a class life. Every
Mhm.
asset is defined has a class life from the IRS that in theory says, okay, how long does this asset last before it's worthless?
Right.
Cars are 5 years, computers are 5 years, office furniture is 7 years. Um, Buildings are 39 years and
Yeah.
27 and a half years. So to take advantage of a depreciation expense, you take the what you paid for the building minus land,
Yeah.
and then you would divide it over 39 or 27 and a half. 27
Yeah.
and a half if somebody lives in it, 39 if somebody doesn't live in it. And I know that makes no sense whatsoever, but you and I both know you stop trying to figure out the IRS.
Right.
If you try to figure it out, you're going to end up in a mental institution somewhere. It doesn't make any sense. So
Right.
anyway, but there are parts and pieces of a building that don't have to be depreciated over 39 years, like kitchens, bathrooms, flooring, window covering, security systems, landscaping. All of those have a shorter class life.
Got it.
So if you're, let's say, you own your building, you put a new bathroom in it, your CPA is going to depreciate that bathroom over 5 years because that's what the IRS says to
Yeah.
do. But when you buy a building that's already built, how do you put a value on the parts and pieces that can be depreciated over shorter class life?
Yeah.
And so let's say your bathroom is 25 grand, we would take that 25 and divide it by 5. But if you buy a building that's already built, that bathroom, which is worth 25,000, is being depreciated over 39 years or 27 and a half. So the depreciation is a whole lot less. But if somebody comes in and puts a value on it, and somebody with construction experience or engineering experience, and puts a value on those components, the IRS says depreciate those over a shorter class life, as long as somebody who knew what they were doing, put an actual dollars and cents to those components.
Yeah.
Progressives do it. We don't care.
Yeah.
It's your depreciation. You do whatever you want. This is in the rules. So that's how cost segregation got started. It was a big court case, but it's been around forever, and
Yeah.
it's nothing new.
Yeah. Well, that's super interesting, and I didn't realize, even that bathrooms and kitchens had different, basically, shelf life, so to speak. So if you're sitting down with, an investor that's had a property maybe for 3 to 5 years, and they just really haven't, you know, found these clues, like what does that initial meeting look like? How do you kind of approach that investor to kind of open up this conversation?
Yeah, and it's a great question. The biggest thing, Caleb, I mean, cost segregation is all about timing.
Mhm.
Sometimes it makes sense, sometimes it doesn't,
Right.
and it will make sense if the client is making money, and the client has to write a check to the IRS, and the client doesn't want to write a check to the
Right.
IRS. Then we have a conversation. If I will hear a lot of times, oh, the time to cost segregate is the first year you buy the property. But what if the first year you buy the property, you have so many expenses
Right.
from purchasing?
Yep.
It probably not,
Renovations.
yeah, it can be a lot, or the property's not even rented yet, and
Right.
you're not making any money. Well, then why would you add another expense to take you below zero on your income? It's a net operating loss. It doesn't make the
Yeah.
timing's not right. And I will talk a client out of that
Yeah.
because they have to pay our fees and they don't get a benefit until maybe 2, 3 years down the road. So I say, let's just wait 2, 3 years down the road and then do it. Then you can pay
Yeah.
our fees and your benefits immediate. So the big thing is do you have a tax liability that is
Yeah.
too big and uncomfortable for you?
Yeah. No, it's awesome. And you'd mentioned to me earlier, that about 90% of CPAs don't really understand this particular part of what you do and the value that you bring. So what are one or two of the opportunities? I mean, obviously you've talked about, lack of cash flow, the timing is really important,
Mhm.
but do you have a couple of one or two examples of clients that you've been able to help, and employ these particular strategies?
Yeah, and so I'll take a step beyond cost segregation. Um, Cost segregation, I think almost every client we have, and I think last year, I think we had 700 or 800 different projects we did.
Oh,
The return on investment is at least between 10 and 20 to 1. So whatever you spend for our fees, the tax savings is going to be at least 10 to 1, probably 20 to 1. But
wow.
let's say you own a property, and you have to put some love into it. You got to, you buy it, and yeah, it was a great deal, but boy, these kitchens are old and bathrooms are old, and I got to replace the flooring. It's got that nasty 1970s carpeting. That's very common. So one opportunity, and this was a regulations passed in 2014, which was one of the biggest tax changes for real estate people ever. And
Wow.
yet you talk to somebody and they say, have you ever heard of the tangible property regulations? And they're going to give you a blank look. No,
Yeah.
I've never heard of them. I rely on my CPA to tell me that stuff.
Right.
So anyway, so the rules are, if you replace that bathroom and replace that kitchen and replace that carpeting less than 2 years after you own the property, you have to depreciate that. You have to depreciate those components either over 27 and a half years or 39 years.
Yeah.
Now, if you cost seg, that's different, but let's try to keep it simple. So the opportunity is, yes, you have to depreciate those new components coming in, but the old components going out,
Yeah.
the old bathroom, the old kitchen, the old carpeting, the old drywall, the old electrical that goes in a dumpster somewhere, that is literally garbage that you're paying somebody to take away, that has a taxable value.
Mm,
Because if you think about it, if you have an asset and you pay $1 million for
yeah.
that asset, whatever it is, and then you start taking parts and pieces of that asset and disposing them, that asset becomes less valuable. Because let's say you buy a $50,000 car, and you get rid of the tires and you get rid of the engine. Well, what's
Right.
that $50,000 car worth? It's not, I don't know,
Yeah.
10,000. It becomes less in value. The same with a piece of property. When
Mm,
you start getting rid of components in that property, the asset, in theory, it becomes less valuable. So the IRS says, take advantage of that.
yeah.
Depreciate the new stuff coming in, but expense the old stuff going out as if it was brand new. Because from a tax standpoint, it is brand new. The
Right.
depreciation starts over again. It's a taxable event. All the clocks go back to zero and start over again. And so you can put a value on everything that was disposed of and take a one-time expense of that. It's called a partial asset disposition. You got your asset and you're taking a portion of that asset and you're disposing it. So you can expense that in the year that the components were disposed of. But
Oh,
somebody's got to, jump in the dumpster and
right.
count the screws and count the put a value, and that's what we do. And I'd say 99% of real estate owners and investors miss it. They
Wow.
miss it. So what they're doing is they're depreciating the new components coming
Right.
in, but they're still depreciating the old ones. So
Mhm.
it's a ghost asset. So you're
Right.
depreciating something that's not even there. And then when you sell your building, you have to pay that depreciation recapture back
Yeah.
on two sets of assets. It makes no sense. The IRS says it doesn't make any sense. The IRS is giving us a perfect opportunity to make it right, and yet 99% of owners miss it.
Wow. That's incredible. Well, so you had mentioned a couple of times, a couple different time frames as far as depreciation goes, a 27 and a half and a 39. How is that determined, which one it is? Is one residential and one commercial? How does that work?
Yeah, one's residential and one's commercial. I guess so. 27 and a half years is residential, a
Okay.
residential class life. I guess if you have somebody that lives in there, the IRS says, okay, the building's gonna depreciate faster and be worthless after 27 and a half years because somebody's living in there versus a manufacturing facility that's making cars or whatever that's 39. Again, Caleb, don't try to figure it out.
Right.
Just take what they give you
Yeah.
and move along. Yeah, so that's the difference. 27 and a half if somebody lives there,
Right.
39 if they don't.
Perfect.
Mhm.
So, for example, if someone's getting a new roof,
Mhm.
they've bought this asset. It's a value add kind of situation, and I love that you brought up, this ghost opportunity that most people miss. So, like, how would someone expense a new roof?
Okay, that is God, I love your questions. They just set me up perfect. And you and I have not spoken before this, but you
Right.
and I should be going on the road because you're setting perfectly. So let's say that you have a residential rental property and you got some leaks in the roof. First of all, if you there is an opportunity where if you do get a brand new roof and it's less than 2 years after you own it, you've got to depreciate that and expense the old. But let's say it's after 2 years. Let's say it's 2 years and 2 days afterwards, you got to put a new roof on.
Yeah.
If you just replace the shingles on a roof, just the shingles, you replace all of them.
Yeah.
Or if it's like a commercial property in LA, you may have a membrane. If you replace the membrane,
Yeah.
I don't care if it's $1 million membrane, Caleb,
Yeah.
you can expense that. And it says that there's an example in the regulations that say if you just replace the roof or just replace the shingles or a membrane,
Yeah.
you can expense it. And there's nothing in there that says how expensive it is.
Mm,
Or if it's below this number, you can expense it
okay.
above, you got to depreciate it. So what I tell people, it's like, look, when you have your getting your roof repaired, go up to the top floor,
Yeah.
look up. Do you see sky? If
Yeah.
you see sky, you have to depreciate that roof. If you don't see sky, you can expense that no
Mm,
matter what the cost is. So if a roofing company says, hey, we got to go all the way down to the trusses and
right.
make sure they have to go all the way down to the trusses and they're just not trying to jack the price up, because if they don't and they can get away with just putting another layer of shingles on or taking the old shingles off and put the new ones on, you can expense that and you don't have to have that expenditure spread over 27 or 39 years. You
That's
can just
awesome.
get it all in the current year.
That's incredibly practical. And I think that's exactly what we're trying to get to on this podcast is give people those tangible tools and information and knowledge to be able to make wise decisions on their assets. So we also, we touched on cost segregation, but practically, I've got some assumptions, but I would like to hear from an expert. How would cost segregation help the taxable income of an investor on a property?
Yeah, I mean, it's pretty awesome. So what you do is let's say you buy a property, you buy a warehouse, and
Yeah.
your CPA is depreciating over 39 years. Um, so that's just the cost minus land divided
Yep.
by 39. But then you put a value on the some of the flooring, maybe some of the wiring that's going to a manufacturing machine.
Yeah.
Uh, some of the plumbing that's going to a manufacturing machine. And you put a value on those, and let's say the original building was 1 million, and then you find $100,000 of components that the IRS says don't depreciate those over 39, depreciate those over 5. So now you have $1 million, you had $1 million divided by 39. Now you have 900,000 divided by 39 plus 100,000 divided by 5. The $1 million is the same, but now you're taking a chunk that was being depreciated over 39 years and you're moving it to 5 years. And then let's say there's 100,000 of parking lot and fencing and security systems. So now what you're depreciating over 39 years is now 800,000. 100,000 you're divided by 5 plus 100,000 divided by 15. So when you add all those up, now you're at 100 and what we've done is we've doubled your depreciation expense for that year because we've broken out the components, set them up in a different class life, increase the depreciation. So now, instead of taking a $22,000 depreciation expense, now you're able to take a $50,000 depreciation expense or 75,000. Yeah. And that's expense reduces your income. It comes right off of your income. And the less income you have, the less taxes you pay. Right. And so that's how it works. It's actually very simple. Once you do one or two of them, it's like, oh, I see how this works. Yeah. But all we're doing is taking what the IRS is allowing us and taking advantage of it.
Yeah. And when you first started doing the math, my brain just started swimming a little bit, And I can see how it could become some simpler over time, but I think that's why there's people like you that are there that do this day in and day out. So for our listeners, if you got a little bit woozy on numbers and, IRS intimidates you, you've got an expert in Kevin, to be able to walk you through, what these benefits can bring and find the hidden opportunities in the building that you already own. And
yeah, and I make it complicated. And my head was swimming too when I was doing the math. It was like, oh, Caleb, please don't ask me for an exact number of the example I gave you because I'm not smart enough to figure it out. I have engineers that can do that.
Right.
But it can be intimidating, but it's really not. The IRS isn't this big bad monolith anymore who comes after people and throws them in debtor's prison. Yeah. They are very easy to work with, and they have set up their tax regulations in a way that it's better than it used to be. Yeah. There's no reason to be intimidated from taxation anymore because you can find anything on the internet. So sometimes if I'm reading a publication and I don't understand it, I'll copy it, put it into ChatGPT and say, rewrite this so it's understandable. And that's, oh, I get it. So there's so many technologies has taken tax regulations and really simplified them.
Yeah. Well, and sometimes we need to be talked to like we're in 5th grade, Yeah. Because we're always constantly growing and learning. And I think having the right tools in place, the right people and experts in place, along with technology, can really streamline and really help, people who own commercial buildings, residential properties, and that sort of thing. So that kind of leads me to a next question is, what kind of clients do you work with? What is that, if you would, perfect client?
Yeah, I get asked that a lot, and my answer is not that great. We work with everybody.
Yeah.
We work. I just finished up a study, a partial asset disposition study, which we were talking about from a client in outside of Dallas, and we saved him $10 million this year. 10 million. So he's obviously, his net worth is in the stratosphere. But then we also, I'd say probably 30 to 40% of the work we do is just single family owners, people who have a W-2 job, want to get into real estate, buy a residential rental, and then have to start managing it.
Right.
And there's so many opportunities out there for that single family residential rental owner that they absolutely positively don't know about. Right. So it's we work with billionaires and we work with the single family people because the single family people end up buying more properties. Right. You can save them taxes.
Exactly.
Like, oh, I get it. Well, I'm going to take this money that was going to the IRS and I'm going to buy another property and I'm
Yeah.
going to do the same thing. And it increases their cash flow. And next thing you know, they're a whale. They're a
Yeah.
billionaire because they own 500 single family properties. So you just never know where it's going to go.
Yeah.
And but my mission, and I touched on this before we started talking, um, is to help people not overpay taxes.
Yeah.
You give to Caesar what is Caesar's,
Yeah.
but not a penny more. Just
Right.
don't, because our government, I don't care what your politics are, you have to admit our government wastes our tax dollars. I
Yeah.
don't care what, who you voted for, it doesn't matter. They waste our tax dollars. So give them as little as you absolutely have to,
Right.
and then take the rest and actually, help yourself with it.
Absolutely. No, I love that because, and I tell our commercial real estate team all the time, we treat the person who's looking for, 1,000 square feet of office the same way that we treat someone who's looking for 150,000 square feet.
Mhm.
I think we have to bring ourselves fully and completely to every single person we come in contact with because there's karma, because there's people remember how you make them feel.
Yeah.
People refer to you, and so I think that's super important. And I think I said it before on my last podcast, is that, all we have is our time, our expertise, and our reputation. I
Mhm.
think those are things that we have to guard very much so. And so, Kevin, are there other aspects of what you do that you'd like to touch on, and other services that you provide that can help folks?
Yeah, yeah. It's so cost segregation is an easy one, Caleb. But then as what we really do focus on is okay, after you buy this property, okay, during the next 10 years, how can we help you reduce your taxes during those next 10 years?
Yeah.
And it could be cost segregation. I have people from LA who I may have who have those detached garages,
Yeah.
and they call me and say, what can I do with this? Well, turn it into an ADU, turn
Yeah.
it into an apartment, turn it into a little apartment. The tax benefits would be amazing. So we help with that. We help with investors who and I hate saying these words, but are looking for tax shelters. Tax
Yeah.
shelters are illegal, I know that,
Right.
but they have this massive capital gain, and they need for this tax year to reduce that capital gain. Maybe they sold stock, maybe they sold a business. So we help them find properties like car washes
Yeah.
and convenience stores and gas stations. And it's like, why that? Because you can depreciate all of those over 15 years, not 39, not 27 and a half. You can depreciate those over 15. And we can talk about bonus depreciation another time, but you can take a large chunk of that initial depreciation and put it into the first year to
Yeah.
dramatically reduce your taxable income
Yeah.
just by buying a piece of property that the IRS says, as long as 50% of the revenue comes from gas or
Yeah.
petroleum, you can depreciate over 15, which is an amazing opportunity. And
Yeah.
then as more and as the owner renovates or does improvements, then what we do is we go into those regulations that were passed in 2014, and we help them expense as much as
Yeah.
possible. But we work with them along the way, because one thing we do find a lot is there's a lot of contractors out there who try to kind of push the limit. We have a one client, they're in Nevada. They own a pretty big warehouse, and they have 6 or 7 of those air conditioner compressors on the roof.
Yeah.
One went down, and then so what the contractor said is, well, let's just replace all 7 of them. And the owner called me and said, should I do this? It's like, well, I don't know from a heating and cooling standpoint, but
Right.
from a tax standpoint, don't do it, because
Right.
if you replace one, you can expense that. You replace 4 or 5, now you have to depreciate those over 39 years, and it's a terrible move. So we work with clients to help structure invoices, help
Yeah.
decide when to replace things, when to repair things from a tax standpoint, so that they at least factor that into their decisions.
No, I love that. And it sounds to me like very much like this is a long-term relationship kind of situation because someone who's growing their business, they're going to start knowing what questions to ask and when. But I think for them to have that touch point, I mean, that's a great example. That's something I never would have thought of myself. So let me ask, do you work with clients that are, looking to do a 1031 exchange? They've sold a property, they don't want to pay capital gains taxes on it, they've got to identify new property. What would your role in that type of situation be if there is any?
Yeah, and that's we do work with a lot of clients who not only do 1031s but reverse 1031 exchange where you actually buy the property first and then sell your property. Um, it's just sometimes I will dissuade people from doing a 1031, Caleb, because it kind of drives me nuts sometimes because the clock is ticking and you
Mhm.
sell your property and then you have what 180 days to find a replacement property and 90 days goes by,
Right.
120 days goes by, the people are freaking out
Yeah.
and then they end up buying some money pit
Yeah.
that is terrible. So I say, are you sure you don't want to just take the long-term capital gains? It could be 15%, 20%, whatever. They're like, no, we don't. So what we do is we would cost segregate their original building. And
Mhm.
unfortunately, the Tax Cut and Job Act that was passed in 2017 doesn't allow the accelerated portion of depreciation to kind of be moved over to the replacement building. The accelerated depreciation is called boot. So it allows dirt. You can transfer dirt to dirt, structural to structural, but any of those components that can be taken out of taken out of a building and put in a 5-year class life, you have to pay that back as ordinary income when you do a 1031. Bad news. Good news, just cost segregate the new building, and the tax savings from segregating the new building will pay for the boot of the old building. So as long as you just keep
Mhm.
kicking the can down the road,
Yeah.
and then sometime take the hit, go off the Bahamas, set yourself up, and get out of the rat race. But as long as you keep kicking that can down the road, there's all kinds of ways to reduce that long-term capital gain or eliminate that long-term capital gain through a 1031 or reverse 1031. So we're involved in that all the time.
I
Mhm.
love that. Well, I feel like we could talk about so much and for so
Oh,
long.
all day long.
Yeah, this has been really, really fun. But I kind of, where can people find you online? How do they reach you? And is there anything else that you'd like us to promote? I know you've got some resources available, so I'd love to hear a little bit more about that.
Yeah, so we have a website that just got redone. I'm very proud of it. It's kajmst.com. Very, very simple. Kevin A. Jerry, MST stands for Master of Science in Taxation. I had to come up with something,
Yeah,
coming up with a name. Let's call it strategic taxation, and it was like nobody's going to know what that means. So let's just call it by my name, and they can Google
yeah,
me, and they can figure it out if they want to use me or not. So it's kajmst.com. You'll get all your answers. We probably have over 100 different blogs. It's all free. Read them, understand them. If you don't understand something, my email's on there. Send me an email or a text. I'll explain it to you. And we're not like lawyers. I hope
yeah.
you're not, but we
I'm
don't
not.
charge people like some people pick up the phone, the clock starts ticking and you get a bill. Now we give away so much, it's ridiculous because the way you said it's karma. The more you give away, the more is going to come back to you. But we just like educating people because it's fun.
Yeah,
And then we have another website where I was you can see that little diploma
yeah.
on the what's not a diploma, it's a certificate from the National Association of Accounting State Boards, and we give CPE, continuing CPE education to CPAs on everything we're talking about, and
Wow.
we don't charge for it, Caleb. We do it for free, it builds credibility and rapport, and we're able to build our client base by getting CPAs who say, yeah, these guys really do know what they're talking about. So we do free continuing education, and then we take those subjects, and that's what we teach our building owners and investors. The same thing. We take out the tax codes and the numbers and all that kind of stuff
Right.
because it can get your brain swirling. But we
Absolutely.
teach the exact same thing to building owners and investors that we teach CPAs, and the national board has given us complete authority to teach on what we want, offer certificates, offer continuing education, because they know we build value and it's not just one big sales pitch. In fact, we don't sell anything. You have to call me back to try to get me to something.
Yeah, I love that. And we'll make sure that we include all of these notes in the podcast so that people, you don't have to write it down right now. All of that you'll be able to reach. But Kevin, thank you so much. This has been a pleasure. Who knew that talking about tax strategies and all this stuff would be so much fun and interesting. So I thank you so much for joining us, and I look forward to continuing to build a relationship with you.
No, thanks for having me. It's always a pleasure, Caleb.
All right. Goodbye, everyone.
Bye.
That's a wrap on this episode of Commercial Real Estate Unfiltered. I hope you found value in today's conversation and feel more confident about navigating the world of commercial real estate. If you enjoyed the episode, be sure to subscribe, leave a review, and share it with somebody who could benefit from these insights. You can connect with me, Caleb David, and the team at David Commercial Real Estate. Just check the show notes for more information. Thanks for listening, and remember, creating space is more than just real estate. It's about building community. See you next time.